Welcome back, everyone. This is the Fundamentals of Investing, Part 2 by Joseph Carlson. This is my thoughts on investing. Overall, what I would want to tell myself when I turned 20 years old. If I could go back in time and give myself the best education I could, I'd try to tell myself all of this. All the information I can fit into 4 different videos. Now, if you haven't watched the first one yet, I would recommend that you hit pause on this, you go back and watch episode 1, Fundamentals episode 1. We cover in it capitalism and how you can use it to your advantage. We cover what investing is and, more importantly, what investing isn't. We cover economies and what we can do to get ahead in life, in our job and throughout our career. We go over how investing is for everyone, every person from every background of every income level. Investing is for you. We go over wealth creation and how it's a good thing. Creating wealth brings stability. It brings peace. It brings flexibility, mobility. It brings all these different very good things into people's lives. So we want to create wealth. And then we go over the various methods of wealth creation. There's lots of different ways that people talk about of creating wealth, whether it's real estate or whether it's collecting gold or fine art or, investing in cryptocurrencies or all these different things. And we go over why I believe strongly that the evidence supports that the public equity market, which is the stock market, is the premier way of creating wealth. There is nothing that beats it, not even real estate. I think the stock market is better because overall, episode 1, we discuss how companies make people rich. Owning equity in businesses make people rich. And you can look at any example throughout any person over any time period. Companies made them rich. There's a tiny fraction of people that got rich without companies, and they're professional athletes, they're movie stars, they're a tiny, tiny subset of a subfraction of people, and then everyone else that's wealthy got there by companies. So equity in companies is the predictable, reliable path of generating wealth. And in this 4-part series, again, if you haven't go through episode 1. It covers a lot of important things. Once we've established that we're saving money, we're ready to invest, and we've decided that the public equity markets, which is the stock market, is the best way for us to invest, we move on to step 2. And that's where we are right now. That is part 2. In part 2, we are going to go over the financial statements of a company. Basically, this is a vocabulary lesson. A vocabulary is learning just the rule set, learning what things mean so that you know how to play in this arena. So if I was going to learn programming, I would want to learn the vocabulary of programming. What is a while loop? What is conditional logic? What is a module? What does this stuff even mean? What does object-oriented mean, right? You'd want to learn what that stuff means, so then you have tools to work with and you can piece things together. Without a vocabulary, you can't piece things together. So in this part 2, we're going to be going over the vocabulary of finance, specifically with investing. We're going to go over the income statement, the cash flow statement, the balance sheet, and financial ratios. Those 4 things represent like 99% of what you want to know when it comes to doing analysis on a company. And there's 3 different statements that companies release publicly every single quarter. They're required to. And again, that's the income statement, how much income the company got. It's the cash flow statement, how much cash went in and out of the business. And then you have the balance sheet, how much debt and cash did they have. Now, on these statements that they release every single quarter, I'll show you that they have like 100 things per statement. And sometimes it's like 200 things. There's really only 10 to 20 things that are important. It's much simpler than it looks when you're going through the actual statements. So you don't need to be an accountant. You don't need to be good at math. You don't need to be good with numbers. You can follow along with this, I promise. This is something where you take something that's really complex and you boil it down very simply. And the more simple you can make it, the better. So the example that I want to look at and go through with you is Visa. Let's just do Visa. Why did I pick Visa? Because it's a company like everyone knows, right? It's just a big company. Everyone knows about it. They have pretty straightforward finances. So it's just a good example to go through. Now, I think the best tool, and I may be a little bit biased here because I created it, I own it, but I genuinely feel the best tool for understanding the finances of a company is Qualtrim. And the reason why is because When you go to Yahoo Finance, when you go to Seeking Alpha, when you go to all these different websites, they make the mistake of thinking more is always better. That just having more data, just throw in all the data because more is better. And I promise you that's not the case. Again, out of the 300 different line items of financial information you get from the income statement, balance sheet, cash flow statement, there's 10 to 20 things that are important. 10 to 20 out of 300. So if you display all 300, you're just making it confusing for people to go in and figure out what's important. In Qualtrim, I don't display all 300. I could have 300 charts to go through. You could just scroll all day through different data and charts. That's not helpful because most of those are meaningless to what you're trying to figure out with a company. Most of them are just ancillary tangent data that you don't need to look at. So I believe Qualtrim's value is not in what it shows, but more importantly, what it doesn't show. Everyone else is trying to show everything they can. What I'm trying to do here is pick out the most important things and only show those. So you get a good understanding of a company and your understanding doesn't get confused with a lot of non-important information. But either way, this will be helpful whether or not you use Qualtrim or not. I want to go through Visa, and what we'll do is we'll first just go through how we would look at these different metrics. So first of all, if we go through, anytime you're looking at the earnings report of a company, there's only two keywords you need to memorize. Investor relations. Those are it. You type in the name of the company, Visa, investor relations. You just attach investor relations onto the end of it, and there you have. There you have it. At the end of the search, you'll always have from Google a website, like in this case, it brings up Visa's investor relations website and quarterly earnings. On the quarterly earnings, some companies have them formatted really well. If the web developer and designer is really good, like Visa's are beautiful. You have all the years there, you have the quarters, and you can click into any of them. Now they have different financial years, so it's Q2 right here. But you open that up, and there you have it. You have the report. Now, again, a lot of this is non-standard information. Like what they highlight here at the top is stuff that they just want to put into the report that they want to highlight. You go through and there will be commentary from the executives. There will be an outlook, financial outlook if they give one, bullet points of what they think is most important. None of this is required for them to put in. What's required for them to put in is the income statement and the cash flow statement. So right here we have the statements. So you could go into these different companies, you could bring up the statements, and they have the Visa consolidated statements of cash flow, where they have client incentives and share-based compensation and settlement receivables and account receivables and all this different stuff. They break it down very granular for you. And again, when you're looking at this, you're thinking, wow, this is really confusing. This is way over my head. I don't want to be diving into these reports with a fine-tooth comb, combing through all these different things. You don't need to. I promise you don't need to. What I've done is I've taken what I believe are the important parts of these statements, I've extracted them for you, and then I've brought them in to a visual display to give them context. So you don't only see this quarter in isolation, but you see this quarter compared to all the previous quarters illustrated in a visual perspective, which we have a better ability to track patterns and to track discrepancies and to track momentum and growth and decline through visual patterns than anything else. Humans are really good with visual patterns. So there's a reason that people like using Qualtrim, and it's because it's done all of that work for you and brings it into this website. Now, when we go through, what I want to do is I want to just go through the financial statements and the things that I've extracted. I don't want to waste time going through every other, all this type of stuff. That'd take forever. So let's go through all the things that I think are the important thing to track here. We have, first of all, the revenue of the company. Revenue is also referred to as net sales. Net sales or revenue is basically, it's just how much money the company took in. So if I have a company and I sell a product to someone for $100, I just got $100 of revenue. That's it. It doesn't factor in what I paid for the product, what my profit was, what my taxes on it were, if I even made money on selling it. I could have bought it for $200 and sold it for $100. All it tells me is I just have $100 that I took in from a customer. $100 of revenue. So revenue is just how much money the company takes in. It doesn't say anything about the quality of the company, but it does say something about the growth of a company. Because if a company's taking in more and more money, it means that there's people handing over more and more money. Now, whether or not they're making profits is different, but it is a good indicator of growth. One thing you can do, though, that you have to be careful about with revenue is differentiating between organic revenue and inorganic revenue. Organic revenue means that the company's growing without purchasing that growth in a big way. For example, organic revenue is like Costco, just selling more stuff more years and opening up more Costco locations. They're growing through their core business, just doing exactly what it's done. Opening up more additional locations, more customers coming in, more memberships sold. So they're growing organically. But a company might also grow through an acquisition. Like, let's say Costco decided that they wanted to buy Target, right? They might be able to do it. Like, they might have the balance sheet to do it. And let's just pretend for a minute, even though it would never pass regulation, let's just pretend it did pass regulation. So Costco buys Target. Well, the revenue of Costco would immediately, and we're looking at Visa here, I know, but the revenue of Costco would it would go up like $100 billion or whatever Target sells. It would just jump up. So that would look good, but keep in mind, for Costco to buy Target, they'd have to pay a fortune. They'd have to pay tens of billions of dollars above the value of Target, above the market cap. To pay for it, they'd either have to dish out a lot of cash, or they'd have to sell shares, equity in their company, and dilute Costco shareholders. So even though the revenue went up in that case, if Costco buys Target, it's not organic revenue. It's not them just executing their normal business plan and growing through additional customers and additional price increases. That would be an inorganic form of revenue. And the majority of times that companies grow inorganically, especially through very large transactions, they destroy shareholder value. They overpay. They don't have the synergy of the two companies working together, right? The reason Costco might buy Target is they would say like, oh, we'll be able to work together and cross-sell, and we'll combine our marketplace, and we'll have all this synergy that will make our companies better together than they are separate. Most of the time that doesn't work out quite as much as the executives want, and most of the time they overpay and it destroys shareholder value in the process. So what I look for are companies like Visa that largely grow organically. Now, Visa does many transactions where they purchase other companies. So this isn't 100% organic growth. They do have acquisitions and mergers that they do. But Visa does what's called tuck-in acquisitions. A tuck-in acquisition is when a company that's really big buys like a tiny company. So Visa, which has a market cap of like $500 billion, buys a company for like $500 million, right? Just at orders of magnitude smaller. Not enough to even make the news. You won't even hear about it. Visa's done dozens and dozens of these transactions. And they usually do it to buy some little piece of technology, to buy, they have an employee at that company that they want to bring on. So they buy the company with the requirement that they get the executive employee for 5 years or something to work for them, right? They do it for talent. They do it for intellectual property. They do it for software, or they do it for customers. They'll buy little companies, and that's called tuck-in acquisitions. When a big company buys a small company for the purpose of just further enhancing their core product. That's a good thing. Tuck-in acquisitions, okay. Those are things I don't mind at all. Big bloated acquisitions of two companies merging together where there's going to be a ton of synergy, very skeptical about those. Don't like those as much because the statistics are, this is from a Harvard study, 70% of the time it destroys value. Now, let's move on from this. I think most of you understand what revenue is. Again, just how much money they took in, but we want revenue that's not purchased by buying another company. We want revenue that mostly grows organically, and that's what Visa has. We move on to the other segment here. We'll get to EBITDA. One thing I would just want to add in that I'm doing additional work here in Qualtrim. We're making some big changes again, is the revenue by segment. Again, when you look at the revenue overall, it's great. You're like, okay, Visa made $9 billion last quarter. Cool. But what does that really mean? Well, we can look at the exact breakdown here. I can look at last quarter and I can see the $9 billion they made, and I can see how much of it came from services, right? They made $4 billion from services, and services is growing over the past year. I can see data processing. I can see their international transactions. Are people going on vacations? Are they going overseas and doing these international purchases? I can see other, and then I can see these client incentives where this is actually a negative number. It's like how much Visa is incentivizing people to spend on their cards. So this is another tool to just do some of the work for you. Normally you'd have to go into all the earnings reports, look at all this breakdown yourself. I'm doing that for you. It's just going to be included in Qualtrim, and we're going to have more and more of these for the same companies and for additional companies. You're going to see lots of revenues and breakdowns and different things like that. Now, moving on from the revenue, we move on to the EBITDA. This is the other thing that I'd want to highlight as something that is a major financial metric that almost everyone uses. It's a huge financial metric that you should know about. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So it's the earnings of a company before all of that stuff is included, before you factor in the interest the company pays, the taxes they pay, their strategy with depreciation and amortizing assets. So what is this used for? Why do we use it? Well, the first thing I'll point out is this is not a GAAP accounting metric. So it's not in the financial statements. You're not going to find it in the income statement, cash flow statement, or balance sheet, because it's not technically a GAAP accounting metric. But EBITDA has become so commonplace, it's basically common vernacular at this point. Accountants use it all the time, and every accountant will be familiar with it. The purpose of EBITDA, and there is some criticism for this metric, because a lot of people would say, why would you want to track a metric that doesn't include all of these very real expenses for companies? Companies have to pay taxes. They have to pay interest on debt. They do depreciate assets and amortize things. Why would you avoid all of that stuff? Well, the reason that you would want to look at this and not look at all that stuff included is to strip it all away and get to the core economics of the core business. That's what EBITDA really tries to do. It tries to strip away all the tangent and ancillary stuff to get to what the core business is generating. Think about this for a minute. If you're looking at EBITDA and you're not factoring in taxes because it's earnings before taxes, that means you're trying to look at what the company generates in profits before factoring in the accounting strategy of the company. A lot of companies are like, they have different tax strategies. Some of them have really cool tax strategies where they can save a fortune on taxes. Look at Apple. They do all this stuff in like the Cayman Islands. They move money over there. You know, they do a lot of extravagant things to not pay as much taxes as other companies. Well, that kind of muddles the water when you're comparing one company to the other. If one has a different tax strategy than the other, then you're not seeing what the core business produces in earnings. So the purpose of EBITDA is to strip all that away, to strip away the accounting gimmicks, the tax strategy, the interest payments they have on their loans. It's all the stuff that's outside of the core business, because loans and interest payments are outside of your core business. Tax and accounting is outside of your core business. With EBITDA, you're trying to get to the economics of the core business, the products you sell and how much money you make selling those products directly with nothing else included. And that's useful. It's just a useful metric when you use it for what it's supposed to be used for. Does it tell you how profitable the business is at the end of the day? No, because businesses really do have to pay taxes and interest. So it's not a metric that should be used as the final say of how profitable a company is, but it is a great metric to show you kind of what the core business itself without all this stuff is actually generating. So that's what the EBITDA is. Now, the free cash flow is my favorite metric, and this is another non-GAAP accounting metric. So this isn't part of GAAP accounting. You're not going to find this in the cash flow statement. You're not going to find it in the income statement. You're not going to find it on the balance sheet. Sometimes companies will include a metric like, they won't be required to, but companies like Netflix, they include free cash flow. Now, the common definition of free cash flow is it's found on the cash flow statement, and you basically take net cash from operations. So you're taking the cash from the operations of the company, and then you're subtracting out capital expenditures, CapEx. So when you take the net cash, you subtract CapEx, you get free cash flow. So if a company does a lot of CapEx investments one year, this number will go down. If they have low CapEx and high amounts of operating income, this number is going to go up. Another variation of free cash flow that I look at is a free cash flow subtracting out the stock-based compensation, because I think that gives you an even more pure way of looking at the economics of a business. But either way, the whole purpose of the free cash flow is to give you an idea of how much money moved into the company and how much money moved out of the company this year or this quarter, to just see how much money the company has left over to return back to the shareholders. It's like a true form of the amount of profit they have left over. If a company has an undiluted stock-based comp net free cash flow of $500 million in a quarter, that means that they can use that $500 million and they can pay a dividend with it, or they can buy back shares. They can return it back to you, the shareholder. So I really like this metric, and it's a metric that I look at for every company. It's how I value my companies. When I run discounted cash flow analysis and stuff, it's based on the future cash flows of a company, and I believe this is the purest, best way to measure the cash flows of a company. So the free cash flow is something that, again, I take from the cash flow statement, I put it into Qualtrim, I visualize it here by quarter, and then I also allow you to look at the amount of dilution. Because some companies, not all of them, but some of them, instead of paying their employees in cash, they do something tricky. They pay their employees in stock. That way it's not technically cash, but it's basically a payment in kind. It's kind of like saying, well, I'm not paying my employee in cash. I'm paying them in Visa gift cards. So it's technically not cash, right? Come on, it's basically the same thing. It's still value you're paying the employees. It's the equivalent value of cash. So I like to factor that in as well. You can see here that Visa produces a ton of free cash flow, and they don't have much stock-based comp. It's a very good company. It's why I invest in companies like Visa and MasterCard. But you can look at the free cash flow. Last quarter, it was $4.26 billion, and it's just phenomenal. I like companies that grow their free cash flow every year. I focus on companies that are able to do that. And again, free cash flow is subtracting out the CapEx. So if companies have huge CapEx requirements, it's hard for them to consistently grow free cash flow. Now, moving on, we move from the free cash flow over to the net income. The net income in many ways is kind of like the counter to EBITDA. So we looked at EBITDA, and EBITDA is like the earnings before interest, taxes, depreciation, and amortization. The net income is the earnings after all of that stuff. So you do factor in interest, taxes, depreciation, and amortization. All of that's factored into net income. So net income will always be lower than EBITDA. The EBITDA is 6.06 billion. The net income is 4.66. So again, EBITDA is always going to be more because you're not factoring in as many expenses. Net income is always going to be less than EBITDA because you have all those expenses factored in. So you can see kind of the core business here, how much that generates without all of this other type of stuff. And then here you see all of these different type of expenses like interest payments and taxes factored in. So we look at net income here to give an idea of how much profit the company made after factoring in all of these expenses. Now, there's different ways to value companies. You can value them based on the net income, or you can value them based on the free cash flow. Companies can kind of do things to game the net income. Again, advanced like tax strategies, and with accrual accounting, they can expense different things at different times. So I like looking at both of them. I love looking at the free cash flow. I love looking at the net income, and that gives you a better context looking at both of these. But in many ways, the way I look at it is EBITDA is, earnings before all this stuff is factored in. Net income is earnings after all that stuff is factored in, and it gives you a better sense of the overall profitability. Now, we move on to earnings per share, and interestingly enough, the earnings per share are actually very easy to understand. What you do is you take the net income, so the amount of net income the company made, and then you divide that by the amount of shares outstanding. So if we took this 4.66 billion and we divided that by the amount of shares outstanding, which is 2.06 billion, the earnings are about $2.25, right? Because the amount of shares, 2.04, goes into 4.6, a little over 2 times. So again, all you're doing is you're taking the net income, dividing that by the shares outstanding, and then you get the earnings per share. Super simple. There's nothing complex about this. So the earnings per share was $2.25. That's all a company does. So when a company grows the net income and it shrinks the shares outstanding, that's like crazy growth in earnings per share, because you're growing the thing that you're growing the top part of the equation and you're shrinking the bottom part of the equation, which means that the division is going to be huge. You're going to have earnings per share growth that accelerate rapidly. When a company's net income goes down and the share count goes up, the earnings per share are going to fall. So we want earnings per share to grow, meaning we want net income to grow and the shares outstanding to go down. So these are just different ways of representing a lot of the same information, but that's basically it. When you look at net income, you're just looking at the amount of profit the company's made after all these expenses are factored in. When you're looking at the earnings per share, you're looking at the equation of that net income divided by the shares outstanding, and you get this number right here. Super simple, nothing to it. So we want companies that are growing their earnings per share by like above, I want them to grow above 12% per year, 12 to 13%. I aim for 15%. It's kind of tough, but I want companies that grow 15% per year. The way that they do that is they grow their net income by around 10% per year, but they also do share buybacks. When they're buying back shares, it again improves that equation, so the earnings per share grow even faster. And you'll look at that's exactly what Visa is doing. Visa grew their net income by 10%, but their earnings per share grew by 12.5%. Again, how did the earnings per share grow faster than the net income? Because the shares outstanding went down by 2.5%. So these parts of the equation are important. Shrinking share count and growing net income equates to fast growing earnings per share. Now we get to the cash and debt of a company. It's super simple. The way that I relate this is it's just like looking at your household, right? All of us have a checking account and a bank account. You probably check it from time to time to see how much money you have in your checking account and savings account and on your credit cards. If you have more money on your credit cards than you have in your checking and saving, you're indebted. You're using leverage. Leverage is the financial term that people use, the investing term for indebted. But leverage just means that you're using debt to try to enhance returns or get higher returns, to improve your capital efficiency. But just like I don't hold any excess debt in my home life, I don't like the feeling of being indebted. I like the feeling of having more cash than debt. I also like the same thing with my businesses. I like my businesses to have more cash than debt. More cash than debt. You'll look at the companies that I own, and if you look at the balance sheet, you'll find it's not random that all my companies, almost all of them, have more cash than debt. Texas Roadhouse has more cash than debt. Costco has more cash than debt. Apple has more cash than debt. Microsoft has more cash than debt. I have a couple companies that have slightly more debt than cash, and I don't like that. That's a trade-off I'm willing to make some cases, but I don't like it. When I look at Visa here, this is an example of a company that has, it's basically neutralized its cash and debt position. They have $20.29 billion in cash, and they have debt of 20.6. Now, just a couple definitions here. I know you understand what cash and debt is, but just to get a little bit more technical here, cash in this case is not necessarily just sitting in a bank account, but it can be things that are cash or cash equivalents, assets that are immediately able to be sold, that are liquid assets. Things like short-term treasuries are considered cash. So Berkshire has like $170 billion in cash. They have that in short-term treasuries. So cash is anything that's cash or cash equivalents, which a cash equivalent is anything that can quickly be sold for cash. Debt is, in this case on Qualtrim, long-term debt. Debt that has a due date that's over 12 months. initial due date over 12 months. I don't have short-term debt. So if a company has like a revolving credit facility, or they have something where they take out like a month of, credit for this thing, if they put money on their credit cards, I don't include that, because I don't want kind of the operational debt that's in the business. What I want to measure here is the debt that gets companies in trouble. The debt that gets companies in trouble is long-term debt. That is the interest payment, long-term debt that companies use to purchase things, usually big things, and it's subject to interest rate movements because they have to renew it once interest rates go up at higher interest rates. So I look at it as short-term cash equivalents against long-term debt, and that's how I measure my businesses, because I believe that's the best way to do it. Now, why would Visa carry $20 billion of cash when they have $20 billion of debt? Why don't they just pay it off? Can't they just pay it off? It's likely that right now, Visa's cash is earning them 5 to 6% returns. And the debt they have is probably at like 3 to 4%, right? So if they have debt that's 3 to 4% and they're earning on cash 5 to 6%, it makes sense to just hang on to the debt. They're earning money on it and they can pay it off anytime if they want to. So there's some cases where it makes sense for companies to carry debt. But again, what gets companies in trouble, just like what gets people in trouble, is having a lot of debt, having a lot of leverage. To put this a simple way, when you look over the lifetime of the stock market over the past 100 years, the companies that go out of business are ones that have a lot of debt, and then things change in the environment. We go through a recession, we go through a pandemic, we go through a bubble, we go through a slowdown and additional competitors. The more companies in debt, the less available, the less different. I'm going to put this a different way. The more debt a company has, the higher chance it has of going bankrupt in different scenarios. So the amount of scenarios in which a company survives narrows and narrows and narrows and narrows the greater amount of debt they have. A company that has no debt and bundles of cash, that company survives basically any scenario. You can have world wars, you can have Great Depressions, you can have pandemics and things shut down business. The company that has a lot of cash, no debt, is going to likely survive it. The company that has a lot of debt, no cash, it can only survive in the best and most tame conditions, where the economy is good and growing, people are spending money, there's no shock, nothing happens, there's no abnormalities whatsoever. That company will survive that scenario. But as soon as things change and the environment changes, which is inevitable, we are going to go through different time periods with different challenges, just like we did in 2020. As soon as environments change, the indebted company suddenly goes from being okay to struggling and trying to survive. And in many cases, they go bankrupt. I'll give you an example here. This is not of one that went bankrupt, but it's of one that went, it just had an unfortunate time. Carnival Cruise Line. It's a company that had a lot of debt, okay? They have a lot of debt because it requires a lot of upfront cash to build these huge ships and to buy them. And it's not a great business. Cruise lines aren't great businesses. But in 2019, I'd say 2010 to 2019, things were fine. The environment was this narrow environment where things were good, the economy was good and growing, and we didn't face any big shocks or any big challenges. So having a lot of debt was not an issue. But then 2020 happened, and look at what happened to Carnival Cruise Line. Because their business was shut down and they had massive ongoing fixed expenses, their income was shut down, but their expenses were not shut down. They carried a ton of debt, which made it so that during this distressed time, they couldn't afford their expenses. They had no cash to go to. So what did the company have to do when it has no cash to go to? They struggled. What they had to do is they had to raise more debt. They had to get funding from other companies. And when you come to when somebody comes to you and you don't want to lend to them, you're not in the mood to lend to them, right? You don't really trust them. And they're just begging you. They're in a desperate situation. In those type of cases, you have all the upper hand. You have all the leverage. You can give them whatever terms you want, whatever covenants and conditions you want on that loan. You can say, okay, here's a paper you have to sign. You have to pay me back by this time, or you incur 15% interest, right? You can write the rules because they're desperate. Carnival Cruise Line was desperate. They had to get cash. They had no cash to go with. They were going to die if they didn't get cash. So the covenants that they made and the agreements they made with these companies to raise this debt weren't from a place and position of power. They're from a place of weakness, which is not a good negotiating strategy, coming from a place of weakness. And instead of just funding this through their own cash balance, going through debt makes them subject to survival by the whims of other companies. They have to rely on banks and equity companies to have them survive. So right from the basis of it, I don't like owning a company that's dependent on other companies for their survival. That's not a good situation to be in. Furthermore, they had to triple the amount of debt. They had to sell off different cruise ships. So they sold different ships out of their fleet to fund their current expenses. And they sold them at pennies on the dollar. They said, oh, these are old ships. We don't want them anymore. But these were forced fire sales. Again, the company took an enormous hit during this time period that it will take a decade to recover from. When we look at the past 5 years, this is what it did to the returns. It was $55 in 2019. Currently, the stock is at $14. It's going to take forever for this stock to recover. And the one thing that caused all of this pain was not just COVID, it was debt. Debt's what caused this company to struggle this much. Had Carnival Cruise Line had $50 billion in the bank, they could have easily just, their cash balance would have gone down. They would have used some of their cash, which is never great, but their cash balance would have gone down. They wouldn't have had to sell ships. They wouldn't have had to raise more funds at a vulnerable spot with no upper hand, right? They're raising funds at weakness. They wouldn't have had to go through all of that. They could have just sailed through, this bad time period and come out the other side and then recoup their cash balance. And that's what companies do that survive for a long period of time. They have excess cash. They don't have excess debt. So there's many examples of this I could go through. And it shows why when I'm a long-term investor and I'm investing in these companies for presumably decades, I want to own them for 10 or 20 years plus. In order for them to survive for 20, 40, 60 years, they have to have cash. And especially the riskier the business, the more cash they have to have. So a company that's cyclical, that has booms and busts, needs even greater amounts of cash. That's how I view cash. You can view it how you want. Many investors don't care. They buy heavily indebted companies. I think that's crazy because it's only a matter of time until the environment changes to one that's not as tame, to one that's a little bit crazier, and that company no longer can survive. Now, we've gone through most of what I consider to be the income statement and the cash flow statement, the biggest takeaways, your top line revenue, your profitability metrics, your earnings per share, and your balance sheet and stability of the current company. Now we get to the return of capital. When a company like Visa is mature and they have invested and they have extra money to spend, what do they do with that money? Well, the purpose of a company, like I've said before, is to make investors wealthy. Companies are wealth generating machines. That's the only purpose they really live for, is to generate people, to make people wealthier. And they do it so great. They make customers wealthier by offering them goods and service. They enrich customers' lives. They make employees wealthy by giving them a stream of constant income from the work that they deliver. And they make shareholders wealthy by the shareholders that took on the risk of investing in the company reap the rewards of the profits. So the profits, what's left over, is returned back to shareholders of the company. So they're wealth generation machines all the way around, and this is how they generate the wealth. The way that they return money is through dividends and buybacks. Dividends are money that the company has, its extra money that they just throw back at the shareholders. It's a distribution of the extra cash flow a company has. Now, there's dividend growth strategy, which if you invest in companies that can grow dividends over a long period of time, those companies do really well. Because in order for a company to pay a growing dividend, it needs to have growing cash flows. And that's the biggest thing. if you have a company that has growing free cash flow, true free cash flow growing over time, they're going to pay a dividend. They're going to do shares outstanding. They're going to buy back shares, remove shares outstanding so the shares go down and you gain further equity in the company. The reason they'll do that is because they have too much cash eventually. Some of them might save up cash until they have a lot of it, but eventually they want to return that excess profit to shareholders. So dividends are just a distribution of cash directly back to the shareholder. Share buybacks is when the company, instead of paying a dividend, they just buy back more of their stock. Now, how does that work? They reduce the amount of float in a company. So if you look at the company float, which is how many shares there are outstanding, I'll show you a good example. Apple's a good example. If we look at Apple's shares outstanding over time, you can see that during the growth phase of Apple early on, they actually were paying employees with stock-based compensation. They issued more shares. And then they got to a point where they're so highly profitable, so successful, they had so much extra cash that they started to buy back shares and reduce the amount of shares outstanding. Now, if you owned 1% of Apple, let's use a bigger number. Let's say that you owned 10% of all of the shares outstanding of Apple, right there. You own 10% of the company. Well, Apple's doing buybacks, which they buy back the shares, they move it into the treasury, which means the shares are retired. Nobody has them. And they do that by buying out certain shareholders. You can think of this as like, let's say that you and like 5 other buddies want to buy a vacation rental property where you'll all put in 20% of the money and you all can split the time at the vacation rental 20% of the time. Then let's say that you do it, you buy it, and then one of them says, hey, I don't want to do this anymore. I want to get my money out of it. Well, what do the other 4 members do? They buy back those shares. They buy his equity out of it, and then each of them own 25%. That is what a buyback is. It's when the company uses the cash flow to buy out existing members of the equity of the company. And then everyone else retains the remaining equity. So everyone else's equity goes up. For example, right here when Apple had like 26 billion shares outstanding, if you own 10% of the company, over the following decade, Apple reduced the shares outstanding so much with their cash flow that you would own roughly 18% of the company. You own more Apple, more equity in the company when you didn't purchase any additional shares because they did it for you. Apple bought back shares for you. You owned more of the company. So they didn't really actually buy shares for you, but they just made your shares own a greater equity of the company, a greater portion of the interest. So when we look at that, share buybacks are a positive thing when they're used the right way. If Visa generates a lot of cash, if they have a healthy balance sheet, if they have extra cash to generate and they're paying a dividend, they can also buy back shares. Now, there's a big debate of like what's better, dividend payments or buybacks. And there's different tax strategies here. In some cases, buybacks are more tax efficient. In some cases, dividends are more tax efficient. So there's this ongoing debate. But what I'd like to do is highlight the similarities of it. For example, a lot of people say if you want a dividend, you can sell your stock, right? You can sell a share to get a dividend. Well, likewise, if you want a buyback, you can just reinvest a dividend. So if a company pays a dividend and you reinvest it and buy the same company with that dividend payment, that's like a buyback. You basically just manufactured a buyback yourself. You bought back share in the company. You have a greater equity portion from the cash flow. And likewise, if you want to manufacture your own dividend, if the company is doing buybacks and you sell a share, that's like paying a dividend. So you can kind of construct your own version of each of these. A buyback is like reinvesting or dripping a dividend back into the company. A dividend is like having a buyback where the company buys back shares and then you do your own disbursement by selling a portion of it. So both of them are kind of, you can reconstruct the same thing. But in general, what we want are companies that can afford to do both of them and do them consistently. And the way that you find companies that can afford to do buybacks and dividends are companies that have growing cash flow. So we're working our way through these definitions. That is the return of capital through dividends and buybacks, the 2 primary ways they can do that. We move on to ratios. So these are things that we use to measure the profitability and the quality of companies. We have a ratios chart here. I'll go ahead and look at this quarterly. we have one here. It goes back like 100 years. Let's go to the past 10 years. That looks a little bit better. We have Visa, and we have one here that's called return on capital employed. This is a ratio that measures how much money the company makes with the money it has. For example, if you give Visa, if you give the company $100 and that's what it has to work with, how much money will it make in the following year? Well, Visa's making 8% per quarter, so it has returns of capital of around 50%. If we look at this annually, we can see what their return on capital employed is on the entire year. 31% is what they had in 2023, 29%. So very good returns on capital. That's pretty good. That means that Visa is a very profitable company, and when it has money, it reinvests it at a very high rate for its investors. If we look at other companies, for example, we can look at, I think it's DAL, Delta Airlines. Not as good of a company, right? It's no Visa. When you invest in a company like airlines, there's many years they don't make profits at all. So the return on capital employed last year was 12%. At least they made a return, but the year before that it was 4%. And you just see it's not great. The highest it gets is like 20%, and it's not reliable. So when I'm looking at companies, I do try to look for very high quality ones, and high quality ones they typically have very high returns on capital. But then we get into the margins of the company. We go to Visa here, and we go to the gross margins. Let's establish some definitions here, some vocabulary. Gross margin is basically like if you have a company or if you have a product and you're selling this product for $100 and it costs you $30 of product to make the product. So if you had to like get $30 of like solution or equipment or, materials to make this product, then that's gross margins of 70%. That means you sold it for 100 and it costs 30 to make. Gross margins of 70%, right? 7 out of 10. There's some companies though, where you sell it for $100 and it costs you $80 to make. That's more in line of like restaurant companies. So like a Texas Roadhouse probably has gross margins of like 20%, 30%. Let's take a look. I haven't actually memorized it, so let's just go ahead and take a look at Texas Roadhouse's gross margins. We have it right here. Let's bring it up. The gross margins are 14 to 15%. Kind of where I thought, right? 15% gross margins. That means that they sell something for $100 that costs $85 to make. Now you have Microsoft, which is a software company, right? They're not creating food. That's a low margin business. Microsoft's gross margins are going to be 70%. They always try to aim at that 70% gross margins. You can see that they really have a dedicated goal of hitting that 70% gross margins. So software companies have the ability to sell something over and over again, and it doesn't have that much cost of goods to make. Whereas a food company or like a car company or something that has to manufacture something is going to have much higher costs of goods, meaning they're going to have lower gross margins. We move on to the next thing. And the reason that these are organized this way, 1, 2, 3, gross margins, operating margins, and profit margins, is because moving from left to right, it's always going to go from higher to lower because there's more things included in operating margins than there is in gross margins. Operating margins also includes the cost of goods, like the gross margins, but it also includes operational expenses. So think about like, again, if I sell this thing for $100 and it costs me $30 to make with the product and the materials and like the solutions to make it. Well, what about employee cost? What if I had to pay a specialized employee to make it and he costs $50 an hour? Or, right? And what if you had to drive to the store to get solution and he had travel time and I had to pay for the gas in the car that he drove? All of a sudden we have all these operational expenses. The operating margins is the margins after all those operational expenses are factored in. So gross margins is just the cost of goods of creating the thing. Operational margins are like the cost of goods plus all the operational expenses. And then we move to the last thing, which is the profit margins, which this is basically like the net income margins. It's after you factor in not only cost of making the stuff, the operational expenses, but you also factor in depreciation and taxes and your accounting strategy and everything with the business. And this is what's left over. So with Visa, the gross margins are 76%, which is insanely high because it doesn't cost a lot of you don't have to really create anything to run a digital network, right? So the gross margins are very high. The operating margins are lower, 66%. Again, we go from 76 to 66. So it's still a super efficient company. I mean, just extraordinarily efficient. These are abnormally high margins. Visa is an outlier of a super high margin company. And then we get to the profit margins, and we have 53%. So see how the margins went down every time? Gross margins, 76. Operating margins, 66. And profit margins, 53. It went down like 10 to 12% every time. Most companies, again, I got to highlight another example because Visa is an extreme outlier. Let's look at Chipotle. And we could look at any of these companies. Let's see here. Ratios. Gross margins, 24%. Operating margins, 16%. And then profit margins, 13%. That's more like a normal company. No 60% profit margins. That's insane. So most companies are a bit lower, but that gives you an idea of it. The reason that Visa and MasterCard are such extraordinary companies is because they have high returns on capital employed, very high gross margins, very high operating margins, very high profit margins. They have like no CapEx. They have excellent moats and all of that good stuff. So it's an ideal company. They're like 1 in a million, literally 1 in a million. Now, the other thing, and I'm going to be improving this section of Qualtrim, it's not up to my standards right now, is the valuation portion. We have the price to sales, price to earnings, and price to book. And you can zoom in and get some data out of here, like, the different PE ratios the company's gone over. But I've been using a different way to evaluate companies. I don't think it's a good way. In fact, I see a lot of investors doing this where they say, well, from 2009 to 2019, the company traded at a PE ratio of 15. It's at a PE ratio of 25. So it's overvalued right now. I don't like doing that. I'll be going over valuations in the next part, so part 3. I don't like just extrapolating valuations, looking at what it was in a 10-year period with low interest rate and extrapolating valuations. I think there's a lot more nuance that goes into valuations. And I'm going to be doing changes to this valuation chart right here. So this is one that you're not going to see me using much right now. We do have the expenses chart, which I do use regularly. On these statements, companies will share different expenses they face. I highlight the 4 main ones here. In blue, we have CapEx. This is your capital expenditures. CapEx is things like warehouses, trucks for employees. If your employees are like workers and they need boots and vests on and microphones and different things like that, all the gear for them, that's all CapEx. Buying desks and robotics and hard goods, that's CapEx. A lot of that falls under CapEx. This company doesn't have a lot of CapEx. Again, Visa is very capital light. Capital light means that it doesn't take a ton of CapEx to run the business. Now, if you looked at Amazon, you're going to see a huge CapEx spend. Very CapEx heavy business because Amazon's building out the biggest fulfillment center in the world. Can't do that without spending a lot on CapEx. So this gives you an idea of how much physical capital requirements the business has to run. The more capital light, that term capital light means the lower CapEx requirements to run this business. Now, there's another term called capital efficiency, which encompasses a lot more things, but we can move on here. We get to S&M. S&M is sales and marketing. So you have people that are on the phones, calling other businesses, calling residential people, doing corporate sales. Your corporate sales team, that's under sales. Your marketing is like if you're doing advertisements, you're advertising on the Super Bowl, you're doing banner ads, you're paying Netflix and Amazon for ad space or whatever. Like that's marketing. So you have the S&M, the sales and marketing there. The G&A, that's general and administrative. This is where you bucket in all the people that don't fit in these other groups. This is where you have like administrators, managers. You have accounting team and like legal. You have all of that stuff in the general and administrative. Then we have R&D. That is research and development. There's a couple years here, but Visa doesn't have a lot of R&D. If we look at an example here that I think is interesting with the expenses, we can look at Salesforce, ticker symbol CRM. Let's take a look here. You can see that Salesforce does have a lot of growing research and development because they have a lot of developers working on new products, doing new developments, right? They have to spend a lot of money on that. So they spend $1.3 billion on research and development. They also have general administrative. They have sales and marketing here. So they have these expenses as well. But that just gives you an idea of the decline or growth in them and how they bucket them. One thing I'll say about the expenses of a company is it's not always perfectly categorized. And that's not the software. It's not the expense, or it's not the statements either. It's the fact that some companies I've noticed, they kind of put things in different buckets, sometimes not even where they really belong. For example, Amazon does something that's a little tricky. They might put like CapEx expenses in their R&D bucket. Because let's say that Amazon wants to spin up a new server farm. And it's a newer server farm that they're going to do some tests and development on. Well, that's technically like a CapEx expense. They're spending money on hard goods, but it's also for research and development. So what does it go under? Well, they have some leeway to decide what that goes under. So in some cases, it's hard to differentiate what goes in like a CapEx bucket and what goes into an R&D bucket. Sometimes it could go into either of them. So I look at the expenses, but it's not the biggest thing I look at. I primarily just look at the CapEx. I might look at sales and marketing and see a proportion of revenue that is. But in general, what I'm trying to find here is the overall efficiency of the business. If the business requires a ton of expenses to run, then it's going to be very difficult for that business to be super profitable. So that's another thing I look at is the expenses of the company. And that is it. It felt like I went on for a long time, but I wanted to explain this thoroughly. So hopefully this gives you an overview of the financials of a company. Again, there's like 200, 500 different things you could go over, tons of different ratios. But when it comes down to it, you have the revenue, how much money the company makes overall in, not the profitability, but how much they're taking in. I'm breaking down the revenue into different segments so we can see that clear. You have the EBITDA, which is before all these expenses. You try to get to the core business. You have the free cash flow, which is my favorite because it shows you how much cash is left over to pay dividends and do buybacks. You have the net income, which is the measurement of how much money they have left after all of these expenses. The stuff that EBITDA doesn't include, the net income includes. And then the earnings per share is the net income divided by the shares outstanding. So when you have a company that grows net income, that also pays for buybacks and does buybacks, you grow the earnings per share quickly. And then the balance sheet, which I think is incredibly important. And I keep it very simple. I want more cash than debt. Simply put, that's what I want. And then of course we have the return of capital. Companies that pay dividends and do share buybacks, and they can do that consistently, have great returns. So when we're looking at all of this stuff, it's very simple. And as you're looking at it through different companies, you'll notice which ones have good quality and which ones don't. And that's why a lot of people are like, they'll say it's like either lucky that you're selecting companies that are doing well, or they won't understand the reasons why you're selecting certain companies. It's all right here. If you look at the fundamentals over time, it becomes very clear why I select the companies I do. They just have insanely good fundamentals across the board, better than other companies. And they've proven that throughout decades of time. So having all of this information, and especially the history of the information at a glance, is very helpful in determining the quality of a company. So that is a fundamental view, a beginner view, over all the financial metrics of a company. What I think is most important from the statements and from the ratios. Part 3 is going to be valuation. Once we look at a company and we determine the quality, how do we know whether or not we're going to get an attractive return? What does overvalued mean? What does undervalued mean? What is a good rate of return to expect? How do you protect the downside when investing in a company? How do you protect yourself from losing a lot of money? That's the discussion we're going to have in episode 3. Thanks for tuning in.